All right, welcome. Today we're going to do something a little different. We're not just talking about investing, we're talking about architecture. Financial architecture, to be exact. We're going to give you the actual blueprints to build a really powerful, durable investment portfolio. So I want you to start thinking of yourself as the lead architect of your own financial future. Ready? Let's dive in.
So let's just kick things off with a big question. Out of all the things you could possibly do, picking that one hot stock, trying to perfectly time the market, finding that next huge thing, what is the single most powerful decision an investor actually makes? Just mull that over for a second, because the answer is truly the key to everything else we're about to cover.
And here it is, asset allocation. See, it's not about finding a needle in a haystack. It's about building the haystack itself the right way. This decision, how you slice up your money between things like stocks, bonds, and cash, that's the master blueprint. It sets the whole risk and reward profile for your entire financial future before you even lay a single brick.
That brings us right to our first core concept. If asset allocation is the blueprint, then strategic asset allocation, or SAA, well, that's the non-negotiable foundation of the entire building. This is the part of the plan that's really designed to be permanent and just unwavering.
You know, the word here that really matters is bedrock. SSA is all about the long term. It's disciplined and it's fundamentally a passive strategy. The whole idea here isn't to outsmart the market every single day. No way. It's to set a target mix based on your personal goals and your time horizon, and then just trust that plan to handle the storms and cycles the market is going to throw at it over decades.
Okay, so how do you actually maintain that foundation? It all comes down to the discipline of rebalancing. Just look at this example. It makes it super clear. You start with a target, right? Let's say 60% stocks, 40% bonds. But then the stock market has an amazing year. All of a sudden, your portfolio has drifted. It's now 70% stocks. Your blueprint is totally out of whack. Rebalancing is what forces you to sell some of those stocks that did really well and buy more of the bonds that didn't. It's a built-in system for selling high and buying low. And you know what? It's probably the single best defense against that emotional gut check feeling to just chase what's hot or hold on to your winners forever, a trap that gets even the smartest investors.
Okay, so SAA is the permanent foundation, got it. But what if you see something happening in the market, a short-term shift, and you want to take advantage of it? Well, that's where our next concept comes in, tactical asset allocation, or TAA. I want you to think of this not as changing the foundation, but as doing a smart, temporary renovation on one of the rooms to seize an opportunity.
And this just lays out the difference perfectly. SAA is your long game. It's passive, it's for years or decades. TAA, that's an active short-term play, maybe for a few months or quarters. Its whole goal is to generate alpha. That's just a fancy word for returns above and beyond the market average by making a really calculated bet. But, and this is so important, it's always temporary. After that renovation is done, you always put the room back to its original blueprint.
So let's make this feel real. Let's say you're a portfolio manager. This here is your baseline strategic allocation, the one written right into your official policy. It's your long-term plan, and you can see it has a 10% slice for commodities. This is your SAA. This is your bedrock.
Now, your research team comes in, they're all excited, and they have a strong forecast. They think commodity demand is going to spike over the next year and a half. So using TAA, you make a tactical tilt. You temporarily bump up that commodity slice to 15%, maybe by trimming a little from other areas. You're making an active bet to try and capture that short-term opportunity. Then, once that window closes, what do? That's right, you go right back to the original 10% plan. No exceptions.
All right, let's see how these architectural ideas, these foundations and renovations, get applied to one of the most important financial structures any of us will ever build, a retirement portfolio. For this, there's a kind of automated blueprint called a Glidepath, and you'll find these in just about every target date fund out there.
Okay, so when you're young, maybe 30 years old, your single biggest asset is time. You have decades to recover from any market bumps. So the Glidepath puts you in a really aggressive growth-focused setup. We're talking maybe 90% in stocks to absolutely maximize your potential to build wealth over the long haul. Now, as you start getting closer to mid-career, the Glidepath automatically begins to shift your portfolio's focus. It's systematically selling off some of those equities and buying more bonds. The goal here is to gradually pivot from pure growth toward preserving what you've earned as your retirement date gets closer and closer. The blueprint is adapting for you. And finally, when you hit your target retirement age, let's say 65, you've landed. Your portfolio is now at its most conservative state. At this point, the main goal isn't really growth anymore. It's about preserving the capital you've worked so hard for and making sure it can generate a stable income.
But hang on. Not all of these automated blueprints are built the same, and this is a really critical distinction you need to understand. A two-retirement path is designed to be the absolute safest at the moment you retire. A through path, on the other hand, recognizes that, hey, retirement could last 30 years, so it keeps more growth assets in the mix for longer to help fight off inflation and the risk of outliving your money. The right choice really depends on the client.
But here's the thing about those really sophisticated glide paths. They're designed for a hypothetical average person. And let's be real, no client is ever average. This is why the best financial architects know that prefabricated plans just aren't enough. They always start with a custom-built plan based on a deep understanding of the client.
And this is a really fascinating slide because it gets into the human side of all this. It's a powerful behavioral insight. So imagine you have a client who's just terrified of losing money. On paper, starting them with 95% in stocks looks like the best way to maximize their returns. But, and this is the kicker, the research shows that if you just dial that back to 90%, you only give up about 1% of potential wealth of the long haul. And what do you get in return? A client who is way less likely to panic and sell everything when the market dips. Think about that. It's a tiny change to the blueprint, but it makes the entire structure so much more stable for the person who actually has to live in it.
Okay, let's bring it all home with the final briefing. I want you to imagine you're about to walk into a huge client meeting or a really high-stakes job interview. This is the stuff you absolutely need to have locked down.
So here are your 3 biggest takeaways. Number 1, SAA is the foundation. It's the disciplined, non-negotiable core. 2, TAA is a tool. It's a high-risk tool for those short-term renovations, but it's not the whole strategy. And number 3, customization is everything. One size fits all just doesn't work. The best plans are always tailored to the specific client.
And just to make sure you're ready to put this all into practice, here are 3 questions you should absolutely be ready to answer. That first one, it tests if you can manage client emotions and keep them focused on the long-term plan. The second one checks if you know how to tailor solutions for a specific group, like an entire company's workforce. And that third one, it digs into your understanding of risk management. If you can nail these, you're in great shape.
So at the end of the day, here's what it all comes down to. Your portfolio isn't just a random collection of stocks and bonds. It should be a meticulously designed blueprint for your financial life. It's a structure that has to be strong enough to get through the storms, but also flexible enough to help you reach your goals. So the final question I'm going to leave you with is this. Have you really been an architect? Is your plan truly built to last?